It's official. Today the S&P 500 entered a bear market as the index fell 20% from its recent high. How should you react to this as an investor? First, it's helpful to understand what's driven this change in markets. The primary reason is the Fed sharply raising rates in reaction to high inflation. The Fed have raised rates already, but markets expect many more hikes throughout 2022. This is why the sell-off has so far been more concentrated in growth stocks. Increasing discount rates have caused markets to focus more on earnings now than earnings in the future. Value is outperforming growth currently, though most stocks are down. A secondary concern is the risk of recession. Growth was negative for the U.S. in the first quarter, and the Fed raising rates can quite often lead to a recession. Ironically, one of the best indicators of a recession is the stock market itself. This sort of a drop in markets can signal a recession is coming. That said, U.S. jobs data remains reasonably robust for now, with unemployment at 3.6%, so a recession is not a certainty and may be mild if current trends hold. Thirdly, stock valuations had become relatively expensive compared to history over recent years. With stocks trading well above historical valuation levels, some reversion to lower valuations over time was a possibility, even if the timing was uncertain. Finally, there are a host of other concerns. The Ukraine conflict has shaken global stability, pushed up prices and disrupted supply chains. China's economy is relatively weak currently, and a strong dollar doesn't help foreign earnings of most S&P 500 firms. First off, a bear market is primarily a historical observation. With the start of a bear market, we are saying stocks have fallen at least 20% recently. As always with markets, it's far easier to say what has happened than what's coming. Still, there are a few trends that tend to hold in most bear markets. However, bear markets are typically accompanied by greater volatility in daily price movements and a focus on stability and value stocks over speculation and growth stocks. As such, one of the trends we've seen in 2022 is value stocks outperforming growth. However, bear markets are often a time for fixed income to shine. That hasn't happened so far. The bond markets has generally sold off in 2022 so far, as the Fed has signaled aggressive plans to hike rates. This means that the usual protection to a portfolio of holding stocks and fixed income has been less successful.